You wake up, check your phone, and the world looks like it's one bad headline away from falling apart. Layoffs are still happening. Prices still feel high. Debt is everywhere. Wars, elections, trade fights, shaky consumers, expensive houses, nervous businesses. You brace for impact. Open your brokerage app. And somehow the market is green. Again. And that is the part that drives people crazy. Because when life feels fragile, people expect stocks to reflect that fear instantly. They expect pain outside to become pain on the chart. They expect the market to punish bad news the way a family budget punishes one bad month. But instead, the market keeps levitating, drifting higher, refusing to give people the clean crash they've been waiting for. So, regular investors do what regular investors always do when reality and price stop matching. They freeze. They hold cash. They doom scroll. They wait for the obvious collapse. And then the collapse doesn't come. Or worse, it comes for a week, scares them out, and then reverses without them. But here's the real problem. Most people still think the stock market is a mirror. It isn't. It's a machine. A forward-pricing, liquidity-hunting, expectation-shifting machine that can look detached from everyday life for much longer than people think. And if you don't understand what is actually holding it up, you'll keep preparing for the wrong danger. Because the biggest risk right now is not just that the market could fall. It's that millions of people stay sidelined, waiting for a crash that never arrives, while the system quietly rewards the investors who understand what game is really being played. Now this matters because the surface looks weak, but the structure underneath is more complicated than fear alone. The latest U.S. labor report showed unemployment still sitting at 4.3% in April 2026, with payrolls still growing by 115,000. At the same time, the Bureau of Economic Analysis reported real GDP growing at a 2% annualized rate in the first quarter of 2026. That is not a booming economy, but it is also not the kind of collapsing backdrop that usually forces a deep, immediate market reset. And even while the Federal Reserve has warned that equity valuations remain high relative to history, it also notes that household debt relative to GDP is still subdued compared with recent decades, and most household debt is held by borrowers with stronger credit profiles. In plain English, there are real risks, but the system is not breaking cleanly enough to force panic selling across everything. So, if you're wondering why the market refuses to crash even when everything looks bad, the answer is not one thing. It's layers. It's a stack of forces, some rational, some mechanical, some psychological, all hitting at once. And once you see them, the market starts making a lot more sense. The first reason is simple, and this is where most people get it wrong. The market is not pricing today's misery. It is pricing tomorrow's probability. That sounds obvious until you live through it. When families think about money, they think in present tense. Can I pay rent? Can I absorb a car repair? Can I survive a layoff? But markets think in future tense. Will earnings be higher in 6 months? Will rates be lower in 9 months? Will margins recover next year? Will the slowdown stay mild enough for big companies to push through it? That difference is everything. A market can rise while headlines still look awful because the market is not asking, is life good right now? It's asking, are things getting less bad than feared? That is a much lower bar. Stocks do not need paradise to rally. They just need reality to come in above catastrophe. Here's what history shows. In 2009, the market bottomed in March, long before the economy felt safe. Unemployment kept rising after stocks had already turned. In 2020, the market bottomed while the world was still shutting down, hospitals were overloaded, and uncertainty was absolute. The recovery in price began before the recovery in emotion. That's not a glitch. That's how markets work. So when investors keep saying, "How can stocks be up when everything still looks bad?" the answer is often brutal in its simplicity. Because the market already survived the worst expectations. And once the worst case gets removed, price can rise even while the news still feels ugly. The second reason is that the economy is weak in the way markets can tolerate, not weak in the way markets cannot survive. There's a huge difference between strain and collapse. A slowing economy can actually support stocks if investors believe it brings inflation down, rate pressure down, and future borrowing costs down. A soft patch is survivable. A total seizure is not. Right now, the data looks more like strain than seizure. Employment is still growing. GDP is still positive. Consumers may be squeezed, but they have not disappeared. Businesses may be cautious, but they are not shutting the whole machine down. That kind of backdrop creates a weird market environment where people feel bad, but not bad enough to trigger the forced liquidation cycle that creates true crash conditions. Source. And that distinction matters more than almost anything else. Because crashes usually need a hard catalyst. A banking failure, a credit freeze, a violent recession shock, a sudden liquidity break, a moment when investors stop debating and start needing cash now. Bad vibes alone are not enough. The third reason is one of the most important, and one of the least understood. The market can look strong even when most stocks are not carrying the weight. A lot of people hear "the market is up" and imagine broad prosperity. That is often false. By the end of 2025, the top 10 companies in the S&P 500 accounted for nearly 41% of the index's total weight, according to RBC Wealth Management using FactSet data. In other words, a handful of giant companies now have the power to make the entire market appear healthier than the average stock actually is. And this is where the title of this video becomes even more revealing. The stock market may refuse to crash, because the part of the stock market that matters most to the index keeps getting bought. Not every stock, not every sector, not every household-facing business. The giants. The mega caps. The names with fortress balance sheets, insane margins, global platforms, pricing power, and the ability to survive a shaky economy better than almost anyone else. That creates an illusion. The index looks durable, while the internals may be far more fragile. And once you understand that, the confusion clears. You're not watching 500 equal companies rise together. You're watching a few massive leaders drag the headline upward. Now, this matters because concentrated leadership changes the meaning of market strength. If the biggest names keep winning, the index can stay elevated even if a huge number of smaller names are doing very little. And that's exactly what concentration does. It turns what looks like a broad national vote of confidence into something closer to a weighted bet on a handful of dominant businesses and themes. Which brings us to reason number 4. Those dominant businesses are still producing the kind of earnings power investors pay up for. The Magnificent Seven reported actual earnings growth of 27.2% for the fourth quarter, while the other 493 companies in the S&P 500 posted blended earnings growth of 9.8%, according to FactSet. Three of those giant companies, NVIDIA, Alphabet, and Microsoft, were among the top contributors to overall S&P 500 earnings growth. Read that again. A tiny cluster of companies is not just large, it is growing faster. And in markets, faster growth buys forgiveness. It buys time. It buys investor patience. If a company is dominant, cash-rich, and still compounding earnings at a rate the rest of the market can't match, money tends to crowd toward it, especially when the rest of the economy feels uncertain. Because when fear rises, investors don't always flee stocks. Sometimes they flee toward the strongest stocks. That's a key distinction. In a world of unstable consumers, stubborn inflation, geopolitical shocks, and policy uncertainty, investors often become more selective, not more absent. They want businesses with moats, with scale, with pricing power, with the capacity to turn turbulence into market share. And that funnel effect keeps the biggest names elevated. The fifth reason is that there is a giant, silent buyer in the background almost all the time. Actually, there are several. Retirement accounts, passive index funds, ETFs, target date funds, automatic payroll deductions, rebalancing flows, institutional mandates. This money does not wake up every morning asking whether the headlines feel scary. It just keeps moving. At the end of 2025, Americans held $10.1 trillion in 401k plans, and mutual funds managed $5.8 trillion of those assets. Equity funds alone accounted for $3.4 trillion inside 401k plans. Total U.S. retirement assets hit $49.1 trillion. That is not hot money. That is slow, systematic, recurring money. And this is where most people get it wrong. They imagine the market as a giant debate between smart humans reacting in real time. It isn't. A massive part of the market is now fed by automatic contributions. Every paycheck, money flows into retirement accounts. That money gets allocated. A large portion of it lands in index products. And index products, by design, buy more of the biggest companies because those companies already have the biggest weights. That creates a feedback loop. Big stocks rise. Their index weight rises. Passive money buys more of them. They rise again. And no, that doesn't mean fundamentals no longer matter forever. But it does mean a lot of buying pressure is mechanical, not emotional. Which is exactly why waiting for everyone to finally panic can be a losing strategy. Because some of the biggest buyers don't panic. They automate. The sixth reason is even more blunt. Corporations themselves are buying their own stock. Reuters reported in January 2025 that Goldman Sachs expected companies to spend about $1.07 trillion on buybacks that year. Think about how absurdly powerful that is. The companies inside the market are becoming one of the biggest buyers of the market. This is one of the most underappreciated support beams in modern markets. When a company buys back its own shares, it reduces supply. Fewer shares outstanding means each remaining share represents a slightly bigger claim on earnings. That can support earnings per share, support price, and send a signal that management believes the stock is worth owning. Now, buybacks are not magic. They do not save a business with collapsing cash flow. They do not erase recession risk. They do not cure overvaluation. But when you combine buybacks with passive inflows and concentrated leadership, you get something powerful. A market with structural demand. And structural demand is exactly what makes crashes harder than people expect. Because to crash hard, a market usually needs more than fear. It needs buyers to disappear. Right now, many of the buyers are still there.